Hello, ladies and gentlemen. I hope you're fine wherever you are. I am the ACCA tutor, Mr. Jerry Mchimkulu. In this video, I'm going to take you through the process of computing relevant workings with regards to financial accounting problems related to complex groups or D-shaped groups. All right. So we're going to go through together an example which I have provided for your reference. All right. So like I've always said, to benefit a lot from these videos, you just have to get the lecture notes. To be a student with us, if you become our student, you get all the lecture materials, so that when you be watching the video, you would also be benefiting in terms of the enhanced learning that it comes with that arrangement. All right, because when you're a student, you get both the notes and the exercises or assignments which the tutors would be giving you, and your progress would be monitored, such that on exam day you're not going to meet unnecessary surprises. All right, so it is advisable that you also notify your friends, you share them our link, okay, you refer them to us, and then they also benefit. All right, without wasting much of your time, let us get straight to the business of the day. Ladies and gentlemen, we are having this example. Let us just have a look at the information and also the question requirements, so that we know what we are supposed to do. The question is that we have to prepare a consolidated statement of financial position of the huge core group as at 31st May 2022. All right, so we have tried by all means to make sure that the information here is actually relevant to our current syllabus. All right, so those who are anticipating to write the ACCA paper SBR in the upcoming exams, be they September or December 2022, this is actually a good video for their reference, for their revision and practice. All right, so the draft statements of financial position of huge core, mega core, and pliable core as at 31st May 2022 are as follows. So we are given the information of 3 companies, and this is almost typical of ACCA SBR papers, where you be given the statement of financial position for the 3 companies, and you are required to then make or to report these companies as one entity. That's the purpose of group accounting. Okay, in terms of international accounting standard number 1, you just have to make sure that companies in the same group or under the same control should actually be reported as consolidated companies, okay, as a single entity by the end of the day. All right, so this is the information here, and from the analysis, you can see that this information here shows that huge core has some subsidiaries. All right, and he has bought his investments in other companies, be they in subsidiaries or associates, but you can see that there is evidence that it owns some shares in another company, and then they've got this company called Megaco. It also has got some shares in another company. But which company do they have shares in? For huge core, you can see that it has got shares in Megaco and Pliable, and then for Megaco, you can also see that Megaco has got shares in this company, Pliable, because as you can see, it's the same line. All right, and the examiners have actually indicated that in that line, that particular line, that's where the information for shares in Pliable are found. But as for Pliable, it has nothing. It does not invest in any other company. All right, so what does that entail? Okay, it means that we have to establish what type of relationship exists or what type of investment in this particular company. All right, so we need to read more facts to understand what is going on. So we go to the question additional information, and we are told that UGCO acquired 60% of shares in Mega. All right, so huge, all right, acquired shares 60% in Mega. So these were 60%, 60% shares. All right, in Mega. When was that? It was in January 2020. All right, when the balance of the common retained earnings was 8,000 credit. And when we are saying 8,000 credit, it means that they were positive profit. They were not losses. And there was no share premium account. Then we are also told Huge acquired 20% of the shares of Label Co. and Mega acquired. So you can see that Huge went on to purchase 20% of the shares in Label. This is why we are seeing the information here about this. So this was actually 20%. Okay, an acquisition by Huge. All right, so Huge acquired 20% in Pliable. So we can see that Huge has two forms of shareholding. It has 60% shareholding in Mega and 20% shareholding in Pliable. All right. So on the face of it, Pliable could be an associate. Okay, could be an associate so far with the information that is given. All right, but you need to read further. UGCO acquired 20% of the shares of Pliable, and Mega acquired 60% of shares of Pliable. So you can see that in this situation now, we are having a typical D-shaped relationship, because we are having something like this. And I encourage students to draw a group structure. All right, so group structure is their part of their working number one. Group structure, let us just say working number one. Okay, so we have got Huge here. Huge buys 60% from the information, 50% of Mega's shares. All right, but Huge also bought 20% of Pliable. This is Pliable. Okay, and this Mega bought 60% of Pliable again. So you can see that's the type of relationship that is ensuing so far. All right, so when Pliable bought the shares of, when Mega bought the shares of Pliable on 1 January 2021, the retained earnings were 15,000 of this company. However, we also need to know that from 1 January going forward, that's when the group's account, that's when Pliable became part of the group. All right, remember in our previous video on week 1, we stated that the subsidiary becomes part of the group when its shares are acquired by the subsidiary. Okay, when its shares are acquired by the subsidiary, that's when it becomes part of the group, provided the subsidiary was already part of the parent. Okay, provided the subsidiary was already part of the parent. All right, but in this case, it okayed on the same date. Okay, it doesn't matter. It okayed on the same date when UGCO was acquiring 20% of the shares here. Of the shares in the subsidiary, and also when its subsidiary Mega was acquiring the 60%. So that's when automatically this Pliable, the sub-subsidiary, became part of the parent. Okay, so for the purpose of our computation, we then need to establish what was the effective control and what was the effective non-controlling interest. Okay, so you can see that there is the mainstream NCI, all right, that the mainstream NCI or the direct NCI, which could be seen between the holding company huge and the subsidiary mega, right, which exists at let me just say NCI in mega. NCI in mega is equal to 100 minus 60, all right, the 100 minus 50, okay, percent, and this is 40%, okay, because huge bought 60% of the shares in mega, all right, but we can also see that there is some effective control which could be established in the sub-subsidiary, all right. So effective control in P or in Pliable, the sub-subsidiary, is actually given by there is 60% shareholding in Megan, okay, but Mega purchased 60% in Pliable, so that's 60%, okay, and this gives us 36%, all right, but we have to add direct control, direct shareholding, not controller, because this one is not a controlling stake. 20% wasn't actually a controlling stake. So direct shareholding in P was 20%. So if we add 20% and 36%, we get 56%. Okay, so 56%, that's the effective control in P. So what do we do for NCI? We say now NCI, okay, the NCI in Pliable becomes 56 minus 100 minus 56. This is 44%. Okay, that's the 44% which we will use as part of our computation for the NCI in Pliable. All right, this NCI is made up of the direct and indirect NCI in Pliable. All right, so the direct and the direct NCI in Pliable is usually found as the balancing figure, but you can determine the indirect mathematically. Indirect shareholding, not shareholding, but NCI. Indirect NCI is equal to okay, when the holding company H, okay, when you purchase 60% in M, we indicated that there was an NCI of 40%, okay, because they purchased 60%. All right, so the indirect NCI in P is actually 40% multiplied by the shareholding of Megan in P, which was 60%. The shareholding of Megan, not Megan actually, it's Megan. Okay, that's 60%. So we get 24%. And obviously, 24 minus 44%, we get 20%. So the direct NCI is actually 20% in pliable. Okay, I mean, but that working out is not actually very, very important so far. But for you not to be confused on, when you are reading some of the textbooks, you might be confused to understand where the direct NCI is coming from. And actually, I hope you have been enlightened there. All right, now after getting this reality, let us now do working number 2, which is normally the goodwill. All right, let us determine the goodwill for our computation. All right, now for the goodwill, we just try to use the darker pen. Working number 2, goodwill. Okay, we have got 3 companies, but we want to determine the goodwill in the 2 subsidiaries, that is Mega and Pliable. All right, so we just have to have our companies as they are, so that we see what is going on. All right. Okay, we have got the first company is Mega. All right. Okay, so now we want to establish the goodwill in both of these subsidiaries. So we've got subsidiary Mega and subsidiary Pliable. Okay. All right. So what was the consideration transferred? Consideration transferred. All right. In Mega, if we go to our balance sheet here, we can see that the amount of consideration which was transferred was 90,000 in Mega. All right, which was actually a direct transfer. All right, so the direct there, that's let me just say direct. This was how much? 90,000. Okay, and for Pliable, the direct was how much, which the parent actually paid. The direct consideration is the amount which was paid by the parent itself. Okay, and it can be easily seen from the balance sheet as indicated by the parent's balance sheet. They paid 25,000 direct to Pliable when they were purchasing the 20% shareholding. So that's the direct we are talking about. Okay, that's 25,000. All right, and then let's talk of the indirect. However, in Mega, there was only a direct payment. All right, because they bought Mega directly, not through another company. But when they buy Pliable only became part of their group or become part of their subsidiaries because it had been bought by another subsidiary. So automatically it also becomes their sub-subsidiary. All right. So this is why we are saying there was also an indirect consideration. The indirect consideration there, we need to establish that. We know that Mega, when it was purchasing Pliable, it purchased 60% of the shareholding. So automatically the consideration which MEGA paid to Pliable was not a full 100%, but only 60% of the amount. So we now say 60% multiplied by the amount which MEGA paid. And from the balance sheet, we can see that MEGA paid 42,000. So we then come here and say 42,000. 50% multiplied by 42,000. And we should get, let me see from this calculator of mine, that's 25,200. 25,200. Okay, once we did that, we are told by the question, by the examiner that it is the group's policy to measure the non-controlling interest at acquisition at each proportionate share of the fair value of the subsidiary's net assets. So we need to establish which ones were the subsidiary's net assets so that we will be able to proceed. Okay, because we need to determine the non-controlling interest at acquisition. Alright, remember, goodwill is determined by consideration transferred at NCI less net assets of the subsidiary. So we then have to determine what were the net assets rather. Okay, what were the net assets of the subsidiary? So we determine that by coming up with some information, okay, which we have to input. So for the net assets, you can have a separate working for the net assets if you do not want to confuse yourself. Alright, but you can also as well just do those computations here. You know that you have to determine the NCI at acquisition. Okay, but you also have to know of the net assets. Okay, the net assets in the subsidiary or at acquisition as well. Okay, how can we come up with these figures? We know that our net assets, if you refer from our previous video, we said that net assets comprise of shares acquired as well as the retained earnings. Alright, shares acquired, share capital, also the retained earnings. Alright, so the share capital usually is just almost the same unless the examiners indicated something which has happened during the at the acquisition date about the shares. But if they are silent, just have to pick the information from the question. So you can see here that the examiner is silent about any movement or whatever that occurred at the date of acquisition. Alright, so shares just have to pick the figures for the respective companies. Okay, we've got 50,000 for MEGA and 50,000 for Pliable. So we just have to plot in those figures so that we do not waste a lot of time. Alright, so for this individual, we can simply say, can just have another column there. Alright, so let us say for the share capital, we have got okay, for the share capital, we've got 50,000, and here, well, of course, I have got 50,000. That's just share some values. Alright, once we do that, we then have to write information for the retained earnings at acquisition now. This one is a bit tricky here because you might end up taking the retained earnings as indicated in the balance sheet. These ones are not what we need because these ones are the reported earnings information when the companies were acquired. Alright, so that information is given in the notes. We know that when Huge acquired 60% of Mega on 1 January 2020, Mega had retained earnings of 8,000 credits, so we pick that as our figure, which we need 8,000. Alright, and then we go for Pliable. For Pliable, the retained earnings figure we need is that figure when it became part of the group, not when it was initially purchased some time ago. Alright, alright, but when it became part of the group. Alright, okay, when it became part of the group. Alright, luckily enough, in this particular question, the 20% was actually paid on the date when Megan also purchased 50% stake in Pliable. Alright, but like as I've already indicated, the purchase of the 60% is actually what made Pliable to be part of the group. Alright, that's when it became part or to be considered a subsidiary of the group. Okay, so we then have to pick the 15,000 on that particular day. Alright, but in some exam questions, the 20% would also could have been bought some time earlier. Alright, and you would be given some information about the retained earnings at that particular time. No, you don't have to use that information because at that particular time, the 20% did not make Pliable a subsidiary. Okay, it only becomes a subsidiary when a 60% stake was acquired by a subsidiary. Okay, that's when Pliable becomes part of the group. So we slot in the 15,000. I'm sorry for taking much time explaining how. I want you guys to understand what will be going on. So sum up, and we get here 58,000. Alright, and here we get 65,000. Okay, ladies and gentlemen, these are negative. They are negative because by the end of the day, you would want to lessen the net assets from consideration and NCI at acquisition. Alright, that's the idea. Alright, for us to arrive at goodwill at acquisition. So now we are told by the examiners that the group's policy is to value non-controlling interest at the group's proportionate share of the fair value of the subsidiary's net assets. So we know that in MEGA we've got 60%, but in Pliable, our effective control, the effective control in Pliable was how much? We did calculate that. The effective control is actually 56%. So this means that our NCI in MEGA is 40%, in Pliable is 44%. So we then have to say we know the NCI acquisition in MEGA, this is 40% multiplied by the NCI, the net asset for MEGA, which we determine the net asset will determine to be 58%. So this is 58,000. Okay, and for Pliable, the NCI, we know the NCI from the computation. We now know that the NCI is 44%, 44% multiplied by 5,000. So let's find out those figures from our calculators, and we should get for MEGA 40% multiplied by 58,000, we should get 23,200, and for for our pliable, 44% multiplied by 65%, we should get 28,600. Okay, so if we add 90,000 and 23,200, we must get some figure here. And what is that figure? Alright, let us do mentally, but my calculator is misbehaving. The phone I'm using is misbehaving. So that's 200, and that's 3, that's 11. Okay, and for this one, if you add up, right, let me just try to force this one, this phone of mine. That's 25,000 plus 25,200 plus 28,600. That's 78,800. Okay, so we then have to determine the goodwill in each of the companies. So for the let me start with pliable, 78,000 minus 55,000. That's 13,800. And for Mega, that's 113,200 minus 58,000. That's 55,200. Okay, I think we then have to add. Okay, we can add to determine this goodwill, the total goodwill rather. Okay, the total goodwill, ladies and gentlemen, is then found by 55,200, plus 38,800, that's 69,000. So the total goodwill, ladies and gentlemen, has been 69,000. So that's how we have to do our computation. Then from there, we can do the working number 3, which I normally call retained earnings. But you don't have to follow the way I do. Sometimes you might remember to calculate the NCI before the retained earnings. It doesn't matter, okay? But this one is actually a good format of doing things. So retained earnings. Retained earnings, they also come up with the table, but this time for the retained earnings, we also have to consider the huge part of it, okay? Huge, the parent, and then meager and liable. Alright, this information is very important because it ensures that we come up with the right figure. So we first have to just put the figure as given in the question. So you can say per the question. Per the question. Alright. From the question we can determine that the retained earnings at the reporting date. Alright. These are actually retained earnings at the reporting date. We have got this information, that information, and that. Alright. So, but what we know is in the subsidiary, those retained earnings include some information, include some retained earnings which were not part of the group, okay, or some retained earning performance which was outside the group, or which were existing before the company were consolidated or were amalgamated or come together. Alright, so those retained earnings should be done away with. Alright, so let's slot in the figures first. For the parent, that's 45,000 and 45,000, 32, 25. So that's 45,000, 32, 25. Okay, and we are also told that the companies made something. They made some profits if they were trading. Okay, and we know that when Mega was acquired, it had, I mean, 8,000 as its profit. So we have to do away with that. And then when this Flybo became part of the group, it had 15,000. So we have to do away with that. So 8,000. These are called pre-acquisition gains or retained earnings. Alright, and for Mega, there was 8,000, which should be done away with, and here 15,000. That should be removed from our group earnings. So we now get what is called post-acquisition retained earnings. Okay, post-acquisition retained earnings. Okay, so here we get 24,000, and there 10,000. Okay, and then we then have to worry about the group share. In these subsidiaries. So we start with in Mega. In Mega, our share is 60%. Okay, 60% multiplied by 24,000. So 60% of 24,000 is about 14,400. And then in Flybo, we have got about 56% multiplied by 10,000. That's 5,600. Okay, and once we do this, we are done. Once we do this, we are done. Okay, so we then have to add up, and using our calculator, that's 45,000 plus 14,400 plus 5,600, and we should get our 55,000. Okay, once we do this, we then have to also go back to our balance sheet and see if we not missed something. Alright, there is something here and see that there is some revaluation surplus which we need to put into account. Alright, we have purchased 60% of Mega, so the revaluation surplus there is also to be considered. However, revaluation surplus does not affect retained earnings, so we can better give away, give it a separate working. We can better proceed by giving it a separate working. So let me just use this portion. Please don't be confused. It's not part of the retained earnings, but it's a separate one. So we can call it working number 4, revaluation surplus. Alright. The revaluation surplus here is affecting the group as well as it's affecting the parent and the subsidiary Mega. As you can see here, there is that for the parent, alright, and for the subsidiary Mega. So that's because we are doing a consolidation, so we need to have information for each. Alright, so let us just say huge call, and that's 50,000 from the question. 50,000. Okay, and then for the subsidiary Mega Core, alright, because Mega Core is a 50% subsidiary, so only 60% of that 20,000 is part of the group. So 60% there, that's 12,000. So we add them up, and we must get our 62,000, and that's our Alright, so we're done with that, and I'm sure the mainstream working we have to consider is that for retained, and for the NCI is also a challenge in working, but we have to contend with it. So for the NCI, we say working number 5. Alright, so we have got our working number 5, and we can proceed like that. Alright. So we've got NCI. Alright, we've got MEGA, we've got LIBOR. Alright, and don't forget to put your dollar signs. Now for NCI, we need the at acquisition figure. At acquisition, we have done this on working number 2 when we are calculating the goodwill. For examiners usually penalize students, they get confused, they don't understand what will be going on. Sometimes it is better to maintain consistency. Sometimes the examiners might be lenient with you because you'll be understanding what you're doing. So the figures of acquisition should not differ. So that we take our 23,200, this figure, and this figure. Okay, these are the two figures we need. So 22,200 and 20,600. 23,200 and 20,600. Okay, now we did that. We then have to determine the post-acquisition retained earnings share, the share of post-acquisition. All right, share of post-acquisition retained earnings. All right, so we have to consider for the share in MEGA, and we know in MEGA the retained earnings from the computation which we did. All right, we determined that in MEGA they were 24,000. Okay, 24,000, and here 10,000. But our share in MEGA, the NCI share in MEGA is 40%. Okay, so say 40% apply by 24,000. You can indicate by say working number, the working number 3. I think that's what it is here. So that's 10 working number 3, so that the examiners will see. And if you do that, you get your 9,600. Then say for LIBOR, that's 44%, apply by 10,000. You can also indicate working number 3, and you say 44,400. We also have the NCI revaluation share. As we did, because we only took 60% from our working number 4. We only took 60%. Okay, but we took 60%, so we have to have 40%. Right, 40% multiplied by the revaluation was 20,000. So multiplied by 20,000, and we get 8,000. The NCI includes both the RE as well as the revaluation surpluses and so forth. Alright, but we mustn't forget to lessen the NCI share of investment in LIBOR. Okay, remember we bought 60% through MEGA. Alright, so the 40% of the consideration should be deducted. the consideration we paid was 42,000 through NIGA. All right, when we were purchasing the shares in Flybo. So this consideration should be deducted, and this should be 16,800. All right. So we can see that our NCIs should add up to 24,000 and 30,000. All right, and we can safely add them up, and we should get our 57,000. Okay, once we do this, ladies and gentlemen, the chest is not yet over. We have only done the working, and you can't afford to lose your marks because you forgot to do the final presentation of the balance sheet. Now, what is required is to come up with the consolidated financial position. So, we are talking of the huge group. Huge group. So, some of the information is just to pick from the statement of financial position and slot them in. All right, just have to pick the information there as those for the tangible assets. You just have to pick the 90,000, 50,000, and 50,000 because as long as they are all subsidiaries, it's just an issue of line by line consolidation. So we start with the heading statement. You don't say statement because this one is consolidated. It's a group, so that's consolidated statement of financial position as at 31st May. Okay. In the exam, you need to move on. You need to fly actually. So assets. Okay, we start with the non-current assets, and these are given as tangible assets. Tangible assets from the question that we have in 90, 50, 50. So 90 plus 50 plus 50. That's how much? Okay, 90 thousand plus 50,000 plus 50,000. That's 210, isn't it? Then we determined goodwill. The goodwill was in working number 2. Working number 2 was saying our goodwill was how much? 59,000. So we should get 9,000 plus 210. That's 279,000. 279,000, and then we have to add up current assets. Okay, current assets from the question. These ones we just group this current assets. So that's 40. Then you have to add these figures 40, 50, 40. So that's 80 plus 50, 130. 40,000 plus 50,000 plus 40,000, 130. So add up with 279, it comes to 409,000. Okay, once you do that, you go to the equities and liabilities side. Equities and liabilities. Okay, so let's start with the equity component. Equity. capital. Share capital. All right. Share capital from the question. We just have to pick for the parent only. That's $100,000. So we just have to pick for the parent 100,000. All right. Then, if there was any share premium, we also have to pick from the parent. Then, revaluation, valuation surplus, revaluation surplus, because it's also given there. And the trick is, please don't just simply add up. Those ones need working. So the revaluation surplus there, we determined it on working number 4. So you have to indicate to the examiner that according to working number 4, there was 62,000. For working 4, 15,000. All right. And then we have to worry about the retained earnings. Retained earnings. The retained earnings was working number, if I'm not mistaken, working number 3. Working number 3 was saying we had retained earnings of 55,000. This 55,000. Okay, and we then have to consider the NCI, which was working number 5. NCI, NCI was 57,000. Okay, but to do that, we can add them up and we get our 284,000. Now, we then have to consider if, the liabilities, non-current liabilities. The non-current liabilities, if any, from the question. Non-current liabilities, yes, we have got the 12% loan, which was in MEGA of 10,000. We just have to take it because MEGA is now part of the group. It's a subsidiary, so we just have to slot in its figure. You can indicate and say 12% loan, 10,000. All right. Current liabilities. Do we have any current liabilities from the question? These ones are taken line by line as well. Yes, we have got payables. So that's, we have got 50, 40, 25, 50, 40, 25. Payables, 50, 40, 25. Okay. Can as well do cross check to determine if you picked the right figures. Yes. So, and if you do your computations, that's 90 plus 25, that's 115. So just have to add 115,000. Then get the total, and the total is 409,000. Once you get this, then you can safely say that you have done your part and you have mastered the question. I hope, ladies and gentlemen, we have been helped with this video. All right. If you feel you need further coaching, please don't hesitate to contact me. All right. And if you feel that you can also contribute more or support us, please don't hesitate to just do that. All right. Let me show you the link here. All right.